We've had a very good bounce back. I think some of that was, I don't want to say expected, but definitely something we had started to have a little bit more conviction in just because of where valuations got to. So we felt there were opportunities across the equity landscape for people who could take that longer term view. I think with respect to the Fed, it kind of depends on what the equity market response is to that potential hawkish or dovish outlook. If it is slightly more hawkish and markets respond in a negative fashion, actually, again, that could be a very interesting buying point, because if the market is pulling off on short-term concerns around the Fed needing to get in front of inflation, but actually the long-term fundamentals for some of these businesses, and we see that in certain segments of the market, tech especially, actually that could be very interesting as an entry point for those people who maybe missed out on the opportunity in the last couple of years to invest in some of those higher growth businesses, or maybe missed out to re-enter into the market in the last couple of months as we've seen that bounce back.
Well, the other big data point that markets are watching out for, obviously, is this CPI print coming up today. The expectation is that we will start to see a moderation in those numbers, but still coming off a very, very high level indeed, from 9.1% potentially to 8.7%. To what extent are you seeing that U.S. companies do have the ability to price on higher costs to their consumers? What emerged out of this earnings season?
Yeah, I mean, on the whole, we've actually seen a fairly robust earnings season, and that's not just US. We've also seen that in Europe and parts of Asia. I think in terms of the inflationary backdrop, and especially that cost backdrop that we're seeing for companies, it very much depends on the uniqueness of the business, the innovative nature of that business, and whether they really have pricing power and a unique offering. I don't think we would universally say that companies have passed on that pricing increase to consumers, but definitely in parts of the market where there is a unique offering, we are seeing pretty healthy margins. And actually the earnings pictures look pretty robust through the last cycle of reporting. And for the most part, gross margins, even net margins, have stayed pretty healthy.
Luke, the chip makers have taken a pretty big hit this week. Just yesterday, we got a warning from Micron Technology. NVIDIA also warned earlier on this week. Given that chips are in nearly everything that we use and buy these days, is that worrying to you that we are seeing what seems like signs of a slowdown?
Yeah, look, Juliana, I think we have to separate the short term from the long term. The short term, there are still massive supply chain challenges that we need to try and resolve, and that won't happen overnight. But longer term, as you say, this is foundational technology to basically every single major tech theme that we're going to see across the marketplace over the next 10, 20 years, whether it's 5G, cybersecurity, cloud computing, software. That's a very attractive place to be. And I think there is significant investment that's going to go into the semiconductor space as people try to build independence, at least from a geographical perspective, and so localize some of that sourcing that could lead to very interesting opportunities across the equity space. And so actually semis is a place we're still highly constructive on. You have to be selective. And I think going back to the question earlier around pricing power, I think you have to find those companies that have unique capabilities. We wouldn't necessarily be playing in the commoditized semi space, much more those with innovative technologies that can play into the higher end part of that tech ecosystem. But that for us is still a very attractively valued entry point for something that might face some short-term cyclical pressures but has major long-term structural demand tailwinds.